Today, this is what we heard from the Fed chair at the end of the Jackson Hole symposium. This is the word that they've come out with as far as their action on policy rates are concerned if inflation remains sticky as it is. In fact, he has said that their restrictive policy will continue until inflation is seen slowing down sustainably. Listen into what the Fed chair said.
Real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward, 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points.
Well, that's what we got from the Fed chair not too long ago. Mr. Prabhakar, what's your reading of what the Fed chair is saying, what Jerome Powell has said? Because arriving at a clarity when it comes to the neutral rate, he says that is still not happening. How are the markets going to take what he says?
This is going to be very negative. Rising interest rate or interest rate stabilizing at current level is something which market is anticipating. So till interest rate cut is not coming, the market will be volatile. But in Indian market, the situation is very different. So there can be a short-term correction, but long-term prospects for the economy is very good. Our rates are very stable. So I don't think that will have a long-term impact. But yes, 1 to 2 months impact could be there due to high interest rate.